Alrighty, I think we are live. Just give us a minute. First live stream I've done myself ever, so we'll just wait a few minutes to get everything sorted. All right, let's jump in. So first live stream I've done by myself. So bear with me as we work through technical details, but I'm going to be hopefully doing these more often. A bit of a deep dive on the markets, my view on various assets, Bitcoin, stocks, commodities, and more. Give you a bit of an insight into how I think about markets, the data I look at, and the process we take, or I take, but kind of thought process that's also comparable with what we take at Caprioli, which is kind of a top-down analysis of markets generally. So it's a pretty good time to be doing this as Bitcoin's just kind of smashed through 75K. And so let's just get rid of all these ugly lines here. But yeah, always the price chart is a good place to start to see what's happening at a higher level. So we're about 75, 200 right now. But I'm actually going to just spend most of the time going through the Caprioli platform because this is basically what I use now day to day for all analysis. So let's just jump in. So the first thing is just price. I'm going to focus on Bitcoin quite a bit today, and if we get time, we'll jump onto other assets. But given we're at 75k mark, this is probably a good one to start on. So if we just zoom in, starting top down, I always like to just do a really simplistic technical analysis overview of markets if I'm just trying to get an understanding of where things are at, firstly, and then we'll get into more advanced approaches. But the old cycle 2021 all-time high is at 61k. So let's just, I'm not even sharing screen, rookie error. Just yell out in the future if I'm not doing something like that. But yeah, so the old all-time high is at 61k, and we're currently actually breaking through the 71k high, which was set in March or in 2024. So just basically marking out what I think the key technical levels on the chart, starting top down from monthly, as these are probably the most important price levels, in my opinion. Obviously, everyone does this a bit differently. There's some nuance to it, but experience does play a part. I'm by no means perfect at this, but this is what I find are the invaluable levels to me. So when we had the big plunge, the market's down, I think we breached 50% very recently. We can just check that. Yeah, 52% odd in the last month. We found a pretty strong support at the 61k region, which happens to also align with production costs and a few other things. So there's some fundamental reasoning for that as well. But good old technicals does a good job at processing that as a potential near-term support. So in the last sort of 6 weeks or so, in the sort of 60, 70k region, I've been pretty openly saying, and in different streams saying, that this is a value zone. It's not as deep a value zone as we've had in prior cycles, but it is a value zone, and you pretty much can't go too wrong if your view is multi-year in some kind of position sizing now, provided you think certain risk factors like quantum are addressed. I'm still holding that same view. Some things have changed more recently. For example, my last stream I did about a week and a half ago with CCI, I noted that if we hold above the 70k zone for the next, call it, couple of weeks, ideally more, of course, but then that would give a good sign of technical strength, which could see us rally in the near term a bit higher. So what does that mean? So right now we've closed the weekly at about 72k. So we broke the last 71.5 support. For me, that's a pretty strong sign of strength. Like, we had multiple weeks below this level, and that was kind of like bearish confirmation as that happened. Now, a really nice signal I like, and you see this a lot in Bitcoin, but all markets, is when you have a range. You can define a range many ways. We can call this a range here as well. If we just go on the weekly time frames and modify it slightly. So you can call that a range. You can call this a range. And when you kind of reclaim a level after spending time below it, so this 71k for me, kind of new resistance in the near term. We spend time below it and then we broke above it. That's actually a very strong bullish sign. So normally you'd expect to see this move up to the next level at the very least. And probably, usually that can happen quite quickly, within days. But it doesn't have to, of course. None of this is a guarantee, but it's just probabilities based in how these markets behave. So in the short term, that makes, for me, 80k an obvious point that we're probably going to hit in the next week or two, provided, of course, no new market changing dynamics occur. No new wars and different things like that, right? No new major changes, which can, of course, always happen. But provide that holds, then I would expect at least 80. If we get a close above 80, that would be really, like, basically a strong confirmation that the false breakdown is legit on an even higher time frame. So that's the next sort of monthly range up here. If that happens, then you would expect at least a movement to the middle of the range, around 95, 97, and possibly all-time highs. But that's not on the cards yet. The first marker is 80K on a technical point of view. Again, we haven't even looked at any of the data on the platform, but just from technicals alone. So try and do every analysis as I think about things, what a metric I'm looking at. I try to look at it distinctly so you don't get too biased from other data. Like there's data that does support this, there's data that doesn't. But if you look at each metric and data point distinctly, you're less likely to introduce bias and to get the most value out of that metric, and then you can kind of aggregate them at the end. So for this tells me we're probably going to get 80K, which is actually a resistance until we close above it on at least a weekly or monthly, ideally monthly, but and that could happen in a couple of weeks. Who knows? But until then, resistance. So from a technical alone point of view, you'd probably want to sell that or at least de-risk it, and wait until we get confirmation and close above. When we do, you'll see that price can move really swiftly. There's some good examples. Like even here, we had a couple of weeks below this 61K of support in 2024, and we had a really strong rally to close the range above it. There are better examples through history as well, where that's worked out quite well. You can even look at 2021 and see we spent some time. Sometimes you do get a false confirmation like this. That can always happen, but more often when you get it, you get these big moves to the top of the range, like we had in the second half 21. Anyway, that's technicals. I like to do that kind of human approach at first, just because it's easy, it's quick. You get a taste for where the market might be at. You get a taste for what most people doing technical analysis might be interpreting. But there's more powerful data and useful data that obviously we use for our fund. It is a systematic fund, but also on this platform, we've got over 100 metrics here now. It's getting built out pretty substantially, so I'm excited to share some of that with you guys today. So that's the high time frame technicals. We can also look at the S&P just quickly, because the picture is less clear, I would say, on the S&P 500. Yeah, we've had a bit of a breakdown, if you will, in S&P in the last few weeks. And that's in the back of a few things. Obviously, we've got the war happening. We've got, what else? We've just had a deterioration of some key data points. Main factors there being gold breaking out. And usually when you get gold outperformance in equities, it's not really a strong sign for the market. So I'll keep this part short, but you do have a little level here. We close below it on the weekly as well. Yeah, I wouldn't call this a substantial concern yet. Like this is pretty short time frame weekly. I don't really like to pay much attention to it on equities because it does move a lot more longer term. So there's actually a bit of a support region here on the weekly time frame, I would say, from this candle. I wouldn't draw too much from this, to be honest. I think the fundamental data is more important. But we did have, we spent several weeks, months above 6,800, and that's clearly had a breakdown, which is not ideal. So just something to bear in mind as we go through the other stuff today. So let's jump into some macro charts. Where's the best place to start? I think US liquidity. So if we think top down, what drives price action? It's usually US liquidity, Fed decision making, so interest rates, money supply. And then you kind of step down from there, fundamental data of companies and markets, ratios of markets, credit spread data, bond market data, equities data, sentiment data, then your technicals, and you kind of go from those kind of robust top level down to the bottom lower tier price data sets. So that's how we, or just data sets in general, that's how we kind of process hundreds of metrics here. And the macro sort of metrics are the most important because all markets trade relatively. So if you're getting a lot of US liquidity or a lot of money supply growth or Fed funds rate easings, then that boosts hard assets, gold, usually risk assets, etc. So we'll step down through that. US liquidity, it's been a bit all over the shop in the last couple of years. There's been a few times where it looked like it was going to have a more serious breakout, but hasn't quite gotten there. Um, you can, with all these fundamental metrics, when you're doing a kind of human visual view, you can do a bit of a technical approach. It works on a lot of indices and data points like this, because at the end of the day, it's human psychology driving all of it, and that's what technical is about. When we're actually processing data like this, so each of these metrics in our quant models, we're doing tens of different analyses in each. So we z-score it, we find skew, we find correlations to other data sets, we look at forward returns. There's over 40 different analytics on each metric itself that we pass into our AI dashboard and strategies here. But from just a kind of humanistic, quick and dirty review, this kind of breakout in 2020 in US liquidity, obviously that was in the back of Corona, had this huge virus come out. The US did the most money supply easing of all time, just airdropping checks on people. So that was a big significant breakout. We're kind of consolidating above that level. That's probably less important. Most important thing is that it's just trending up in recent months. And that's good for risk assets. When it's going down, not usually as good, especially for Bitcoin, less so for the S&P 500. You get a similar picture there when you look at global money supply. It's about 117 trillion today. And it's been going up about 10% a year. So that's kind of like the back picture of macro. It's pretty strong. I don't think I'll go too much more into it today, just because I did a lot in the last show we did a week and a half ago covering this stuff. But the short view is that the data is very strong. It's very positive for hard assets, risk assets, and Fed policy, etc., is also supportive of that. Let's look at some other metrics though we didn't cover that time. So insider buying and selling. This is a bit different. So this is looking at all of the SEC filings of S&P 500 companies and what the insiders are doing. That's the directors, the chief executive officers, all the important people who know the inner workings of the company. Are they buying their own stock or are they selling it? Well, they've actually been doing a bit of selling recently, so that's not really a good sign. So this is aggregating all that data and then basically z-scoring it and doing some long-term analysis of it. And the selling is less indicative of market tops. You can just see very quickly here that when there's high selling, it doesn't necessarily mean market tops. The S&P 500 went higher in many of these cases. Sometimes it's a short-term top, right? Sometimes it's a more significant top, like in 2024. But broadly, the sell signals are not as useful. And that is kind of indicative of many metrics. Many metrics are actually better as buy signals, like hash ribbons, historically. So the main thing is, though, that when you get mass insider buying, it's often extremely bullish. So when it's below this green threshold, or even when it's just relatively low, so any of these kind of zones here, right, where this score is quite low, would have been great buy opportunities. Pretty much generally. The point is that we just do not have that today. Today we have relatively selling and not really a significant dip yet. So that's not a good sign. It just tells you that people are worried. And that kind of worried view is actually supported by sentiment. So this also somewhat counteracts that point of view, because sentiment is really bad right now. People are scared about pretty much everything: AI, automation, war, etc. And we're seeing fear and greed hit pretty extreme fear levels. Not yet at exciting buying opportunities, so it can definitely go lower. But we're not like at the, we're not at the greed stage. We're not like at an overly concerning stage there. While we're down here, I'll just skim through a few of the sentiment metrics. If something's normal or has a sort of normalized value in the middle of the range, like here 50, I pretty much ignore it because there's no signal. I just want to see things that are extremes, because that's where the info is at. Active manager sentiment. So with all these metrics, if you want, you can read more about it later. But this one is the average exposure of US equity markets reported by active investment managers. When it's high, there's a lot of exposure. That's usually bearish. And when it's low, it's usually bullish. So we're closer to low than high. It's still not really a signal type level. But again, tells you we're probably not going to go super low, unless something major world event type thing happens that we're unaware of right now. Um, with all of this, it's important to remember that just a year ago we had a massive, well, not massive, but a pretty big pullback in S&P 500. Um, that's important to note because that was on the back of US tariffs going up basically to the 100% level on most major countries, right? Um, and we only went down 21%, and then we recovered very quickly as that was wound back, but it wasn't fully wound back, it was just mostly wound back. The point being, if the market was going to crash on assets being overvalued, on AI cycle ending, on all this fear and event driven things that people throw around, it would have happened much more in 2025, but it didn't. So that's actually a kind of very positive factor, I'd say. That's why I was pretty bullish about a year ago on that front. But we obviously do have the new vector of war, which we can talk about later. Now let's take another look at investor sentiment. Not much of a signal there. So I'm not going to go through too many more macro metrics today in the interest of time. Maybe just one or two others that are more interesting. So put call ratio. It's the top chart here. That's the ratio of puts to calls in the SP 500 options market. When people have a lot of puts, it's usually more of a bullish factor because people are overhedged and they're fearful. So again, a common thread you'll find here is that there's a lot of fear in the markets. It's not yet at extreme levels, so price can go lower. Things can get much worse before that happens. But the point is, we're not near the, we're closer to the extreme of that than to the, the normalized greed scenario, which would be more bearish. So recently, last week actually, we just dipped over the one ratio, and that's actually often a pretty good bottom signal. It lined up with pretty much the, give or take, the price bottom we had around the S&P 500. We have it, you'll see quite clearly through time that these are basically buy signals. Especially if it goes over, it can go over for a while, but then once it closes back under, that's usually the signal. So we've had that. We didn't get as low on a normalized basis as I would like, so didn't get to the green zone. With all these metrics, you don't have to get as extreme as you'd like, but that is still a good, strong signal for me. Not as good as it gets, though. I won't go over relative PE, but basically the markets are somewhat overvalued generally. USD positioning is a good one I like. This is the global positioning against the dollar on all fiat money. And the world is very short the dollar. These periods can last a long time when it's short. When it's red, that means the world is net short the dollar. And that gap has been closing, so people are closing those shorts out. So we're getting a nice squeeze up here in the dollar. It's gone from 96 to 100. This is a factor, I think, largely driven by many events, but de-risking in February and the war. People want to manage that risk and go to the dollar. So this could flip positive very soon. Just reading some comments about Australia. I will come back to that in a minute. So what I want to get on here, so if you want to trade a dollar, this is actually a really useful signal. You can see pretty quickly that could be interesting. But it's also really nice with Bitcoin. Generally, when people are short the dollar, they're looking for ways to, broadly hedge a dollar. And that's when Bitcoin has its biggest rallies. Literally from bottom to many tops, if you will. But it captures a lot of the big trends. So that's actually very bullish for Bitcoin. We've actually had that for a while, and obviously, as with all these metrics, they don't work all the time, but they have to be used in confluence. But that is a bullish factor supporting Bitcoin right here. And assets like gold, like through this whole period when this went short, April last year, give or take, that's largely when a lot of gold's price action happened. Let's have a look. I think that's a fair statement. Yeah, I mean, we consolidated for a few months at 3,000, and we just had this huge breakout on the back of that. Yeah, so it's a very interesting data point. maybe we'll dive into it further detail another time. Advanced decline line. So still sticking out a couple more metrics here. I think it's important. Like people tend to focus in crypto only on crypto and on chain data. It has value, but this stuff is much more valuable. The sooner you realize that, the more you realize um, how interconnected these markets are and how important this macro data is for Bitcoin. It's really the most important factor, to be honest, these days. So this just gives an insight into the health of the S&P 500. Again, you can read about it. If you don't know the advanced decline line, it's a classic indicator, measure of strength. It comes with some of each asset's count of positive returning stocks versus negative. So if 300 stocks went up and 200 went down, then this metric will tick up slightly. You want to see strength in this to support a trend. You can also do some basic technicals on this just to get an eyeball feel for it. But if you look back here in 2025 when we had this top, we had some strength and it kind of broke down and it failed and it couldn't get above this level of the advanced decline line. So we had all the big drawdown, right? So recently, if we move this up to the top, we had a consolidation through 2025 and it broke out in December. We had some strong equities movement at the same time, obviously, and I kind of supported that trend for a while. And now we're kind of seeing what we're going to see, right? Like this is not a major level, so I don't want to draw too much significance from where I've got this line. But basically, we've had a big breakout and it's kind of failed, but is it going to retest and bounce up here? That'll kind of be a sign of strength or not. And I prefer Bitcoin rallies when we have broader risk asset strength like this, because it's just inducive of capital flows into the market. So I'll pause there, but broadly, macro is a bit mixed. The money flows and things are positive. Interest rate forecasts are positive, more or less, but war has kind of changed that. We have some concerning things like insider selling, minor thing to worry about. The advanced decline line is taking a bit of a beating. Again, not yet at a signal type level for me, but something to monitor. Put call ratio is slightly bullish here, I would say. So some very mixed signals, less clear, but on tilt, I would argue slightly positive until we get a further breakdown. Like if we break lower on this week on a few of these metrics, like advanced decline line, S&P 500, any of these other metrics, really, if they turn worse over the next week or two, that would be pretty strong bearish signal. I think for now we have a chance for a decent bounce, just given the put call ratio being really at extreme. That's one of the main factors, to be honest. On top of that, I'll just flick to this table here. You can, I've posted similar tweets before, but you can just Google literally the impact of war on the S&P 500 and you get tons of results like this. And everyone's super bearish right now, I would say, because of the war, because of oil, and everyone's starting to micro-analyze oil prices and the Strait and who's going to defend the Strait and are there mines in the Strait, all this sort of stuff, right? Like that happens at every war. People just start analyzing it, become war experts. I myself have fallen down that rabbit hole before, but to be fair, none of us have any real insights unless you're in the Pentagon. So it's just always good to revert to the broad statistics if you're not a deep expert in each of these fields. And so for war, you'll see that following each invasion or military strike, the percentage of positive results over a day, 5 days, a month, 3 months, a year for equities is the vast majority positive. The average return over the next year is 13%. There are some outliers there, like Afghanistan, down 26%. Cambodia, 11%, right? But you can just very quickly eyeball this and see most are up or most have negligible impact or up. So I think that's important to keep in context here, that it really sucks there's a war. I can't believe we're in another one. But if you're just thinking about investing and in markets, it's actually net positive as opposed to negative that a war has started, as sad as that is. And we won't postulate too much on why that is, but that's just kind of how it's been historically. The The other key factor, though, here, given it's Iran and given the Strait, is obviously oil, and that's what everyone's talking about. Um, and so let's just get rid of that. Oil prices, yeah, are getting quite heavy. We breached, I think, on a high basis, the 100 value, but basically $100 is where markets start to freak out for oil, and that's applied historically too. Um, yeah, we've seen it. Maybe we can just overlay SP 500. We've seen it like in 2008. Oh, I need to move that to another axis. 2008, oil prices went bananas as well. But pretty much every time you go over 100, you get resistance in the S&P, even if it's just short term. Um, Again, not always like we did in there, but all these other cases we did. More recently in 2022. So we're just below that level. So basically, as long as we close below 100, it's probably net bullish, to be honest. It's really when you get over that 100 level that markets start to really panic about the cost of everything, cost of shipping, trucking, all these industries. Of course, there's no single value that really matters, but from a psychological point of view in markets and de-risking and activity of investors, 100 is really a level that's been critical in the past. But broadly speaking, if you have a year and you change in oil that's over 10, 20% and it sustains for weeks or months, that is not good. So basically, net bullish, but we're on the edge of a few factors here, as we talked about. Um, for equities and macro broadly, as long as oil is below $100. And as long as this starts to kind of plateau and come down as opposed to plateau and grind up. So this is probably one of the key data metrics to watch the next few months. If this war continues, if it gets out of control, this could very easily spike and invalidate everything we just said. But for now, it's still okay, but obviously getting onto the concerning side. So let's come back to these comments. Yeah, so the question's about Australia and interest rates going up, and why we're doing the opposite of other countries. I don't know why the Australian government broadly does a lot of things. um, yeah, that's we could have a podcast about that, but it's probably where America was on many topics in the past. Yeah, but in terms of the RBA, it's an interesting move to move against the US. Normally, we just basically copy the US with a few weeks or months lag, and we've done that pretty much every cycle. So it is quite unusual. We'll see how long it lasts. That said, this whole war and what we're talking about now, oil prices being higher, could really change a lot of things. Like if oil does go above 100, sustains that for months or years or whatever it may be, cost of transport, goods, and pricing will all go up because the cost of delivery goes up. Cost of living goes up, and if that flows through to higher inflation, which it could if we stay up here for a few months, then we could have the US stop cutting rates and potentially even raise them at some point. So I'll be honest, basically most of the data or all the data I look at is US and global driven. I don't spend a huge amount of time in Australia because usually we just copy the bigger dogs, the bigger fish in the pond. So I probably don't have much more insight on that one. Yeah. Next comments on war being and whether this Iran thing short term. So if you believe everything Trump says, it'll be over very soon. I think that's very optimistic. It's hard to undo what's been done in the Middle East, especially around neighboring countries, and they're all in kind of conflict now. This is not something that I think will end in a matter of 2 more weeks or whatever it is that's left in his 4 week forecast. Trump has optimistic timelines on a lot of things, like the Russia-Ukraine war as well. I hope he's right. I hope it does end soon. But I would maintain the view that this is a multi-month, probably many-year event. Pretty much all these wars go for 5 to 10 years. If it's some kind of significant thing like this, with Israel dropping bombs, I think on Iran pretty heavily and multiple countries as well. I think that's going to not be over very quickly. Yeah, so we'll move on from there. So that's macro. Kind of mixed, generally bullish, I would say, as long as oil's below 100, as long as some of those other factors hold that we talked about. Let's just kind of pause and swing back to our AI dashboard. So this is passing all of our metrics through the world leading LLMs, all of our articles, research, 20,000 pages of things we've written over the years and analytics. It's also processing charts and the visual heuristics of all those charts that we've done in the past as well to come up with a view of the market. And that processing is basically 20 agents running in parallel, and it takes hours to run. So there's a ton of AI processing in that. You don't want to see our LLM bill, basically. But to come up with these very high-level summaries, for example, we just spoke about equities. Like I said, I don't always agree with the AI, but sometimes it'll pick up things I didn't. And we only covered a few metrics here. So this has covered everything, or hundreds of metrics. And you get a view for what it's saying. So it's actually net bearish, and it's saying the gold to stock ratio is extremely high. So I've talked on this in a recent podcast as well. This is actually really bearish for equities over a multi-year horizon. So we could be already in that window now where equities have their biggest volatility events or generally just don't perform well over a couple of years. So that's, I think, a valid top factor there to worry about. As long as gold is outperforming equities by a ton, as it has been, then we have more charts on that as well if you want to look at it, but it's under macro, gold stock ratio. Corporate insider selling, we just spoke about, not good. Plunging market breadth and extreme fear across retail and active managers could be good for a short-term bounce. So this is summarizing the top 3 metrics it's found signal from, and there's more info here about how it gets to its point of view. Rising credit spreads, definitely concerning. We haven't even talked about that, but that's under the macro ratios here. So many other factors. So it's on net bearish. I can understand that point of view. I think it can be valid. I think the credit spreads have near-term bottomed, and that is historically really bearish. You can see that here. Every time you get a big spike in credit spreads, it often aligns with major pullbacks. So any volatility up in credit spreads, not good. You basically want to see credit spreads just coming down. That's when you get beautiful equities rallies. And so we've had a big spike recently. All these spikes can revert at each point in time, but this is definitely substantial. I would say that is definitely a bearish factor. So, when we do this show, I'm kind of talking from the hip at a bunch of metrics I see. This is a more systematic approach that we use in the fund that aggregates things. I just kind of think a lot of these things could revert soon. They don't have to, but given the thresholds of levels we're at the same time, I don't like to look at this metric either. Discretionaries versus staples. People are spending less on the things that are less important, which usually means obviously more saving activity, less spending in the economy, and not usually a good factor for markets. But we'll see if that can revert soon. So onto Bitcoin, which people are probably most interested in right now. We've smashed through 75k. Is it going to hold? The AI is bullish, but let's take a look. All right, already got a couple of lines here. I think let's go monthly, sorry. Yeah, we touched on this earlier. Strong technical breakout happening, or false breakout, if you will, there, which is really good. So onto the fundamentals of it. The most important thing in the bottom of bear markets, and we may not be in the bottom, but the most important thing is production cost, in my opinion. This has been the best buy signal ever, and I've said that since it came out, and then used it since all the way back here when it came out, 2019. Um, the red line being the raw electrical cost for Bitcoin, and orange being the production cost about 20% higher. So we always spend months in this band every bear market. Um, it doesn't have to happen. We've got less volatility and extremes in metrics, but we did touch it recently. Talked about it at the start of the episode, but around 60K, definitely a opportunity in that production cost band. It's drifting lower at the moment, production cost. So yeah, we just want to. For me, it's probably not yet enough pain on that metric to say, okay, the cycle bottom's in. But again, we didn't really have an exciting top either to this cycle, so it could just be a bit different. But yeah, consistent message for me is that anything in the 60, 70K range is really value long term. If you're holding for a few years, you can't go wrong. Um, if we are lucky and get to the 50 to 60K range in the coming months, that's like a huge opportunity, but it doesn't have to happen. So that's broadly a bullish metric. And you'll see that's a consistent view across pretty much all the on-chain data, is that most of this stuff is bullish. We'll try and look at some different metrics to what I did last time, but it's pretty consistent. Like you've got a hash rate and crossover that happened at 67K, a buy signal there. So after a big capitulation. So some people bring this up. Oh, there's been a lot of buy signals on hash ribbons. And that's right. There will be more and more because this market is more efficient now. We have multi-trillion dollar asset class and a hugely efficient mining industry. So if the miners are more efficient, they don't need to shut down, they don't need to give up, they don't need to do major changes which impact hash rate a lot as often. That means hash rate will grind more smoothly, which means you'll get many more crossovers of short moving averages, which hash ribbons use. So the 30 and the 60, you're going to cross more often. So the biggest thing to look for a metric like hash ribbons then is either you could apply a longer moving average if you want, but just as easily as you just eyeball this and say, okay, where are the deep capitulations? They're the ones that lasted for weeks and months, and they're the ones that really matter. So anywhere this chart goes orange for an extended period, like mid 21, like here in May 24, a couple of months, and this one even more so. This is a big one. So now that we've crossed above, and as long as we remain above, that's, I think, a pretty good signal from the good old hash ribbons metric. I like to look at HEDA quite a bit. This is the aggregation of all of the perps, futures, options markets, weighted by open interest. We also hit a huge buy signal when we dipped into 60K. Now it's kind of more middle of the road. We can see that if I add some colors on this, if I just make the perps market orange, purple, we were pretty deeply short at the 67, 70K range. So a lot of people were shorting in here, and we had this huge rally up. It's more close to normal now, so that move is largely complete from this perspective, but it's still most of them are net negative, net below normal. So that that's a positive factor in the background. So that's a good thing. On top of good things is the miner sell ratio or sell pressure. So it's looking at all the outflows of miners on their stack and normalizing it. Massive sell pressure recently, and that's a huge buy signal. So if again you look at where this is green and where we've had some substantial price decline, like here, and pretty much every case, right? You'll see after a big price drop, and then you get that bang. Yeah, bullish. So that's a really bullish factor right now. That's also a sign of capitulation. So we've had a big hash ribbons washout. People were saying it was a storm in the US, but it's been going for months now. Hash rate is now recovering a bit, but it has dipped down again recently. So we'll need to watch where that goes. But yeah, so miners have been in stress. Some have probably shut down. Many, you've heard the headlines, are converting to AI. So those are all sort of capitulatory signs. Doesn't mean it can't get worse, but it is definitely a sign of relative value, as opposed to when we're in a bull market and everything's great and extended. So there's lots more in here. This is actually a technical metric, weighting momentum and volume, and it's also flipped positive at around 71k, a bit under. So that's also a good sign as well. So we've got quite a lot of confluence on fundamentals and technicals for Bitcoin across the range. So let's see what the AI is saying. Oh wait, of course I got to talk quickly about institutional buying. Um, it's just gone up through the roof. It's hit over 400%. So that's pretty massive. That's probably the key thing in the last week. So institutions today are buying 400% of the Bitcoin that's mined. And that's from ETFs and treasury companies. So that's very bullish. All the big price moves we've had in the last few years, last 5 years, have been in the backdrop of that kind of 200-300% plus institutional buying where they're right now. So this alone, plus all the other things we looked at, tell me we could definitely go to 80 and probably higher, but we'll just need to see. Now, some people might be asking about quantum. I'm not going to spend a long time on that because I've spent so much time on that recently. If you want to learn more, read the article I wrote recently. This all still applies. The main thing here is that every single quantum expert, physicist, tier one company is expecting Q-Day in the sort of 2029 to 2031, 2 region. So somewhere in here, call it here, right? Somewhere in there. With a few people earlier and a few people later, of course, but that full distribution is within the next 9 years. So it's not 10 plus years, as Saylor would say. Every estimate is within 9 years. And so we did a lot of analysis, aggregated all that data, did some probability distributions on it. You can read it here. There's a detailed Substack and the spreadsheet with all the calcs are there too. But basically today, the probability of Q-Day occurring today is obviously very low. It's, what is that? I can't really read it, but it's about 1%, less than 1%, 0.5%. So there's almost no chance that it's happening today. Good, because we're not ready. But if you then discount back the risk in 2 to 3 years' time, the probability of that discount factor against Bitcoin is about 23%. So every metric today, any value metric, energy value, whatever, I am discounting by about 23%. And for those reasons, even if you do that, it means we're still very undervalued. So that's 23% right there. So that means that Bitcoin today is worth, in my opinion, 90,000. Obviously, this is a metric that changes every day, but right now, it's 90,000. It was, over 140,000 last year. And energy value tracks the fair value of Bitcoin really well since inception. And this metric hasn't changed. Its calculations are the same since 2019. So I really like this as a fair value guide. I like that we're trading a discount even when you consider all the quantum risks today. But obviously that quantum risk is going up with time. So we need to see a few things happen. We need to see the core team do something about that. And we need to see, as we trend up, we need to see energy value go up. So that's miners committing hardware and working on Bitcoin in tandem. So anyway, broadly, we're in a deep value zone. Sorry, a value zone. Not yet super deep because we don't have the production cost, but very strong for Bitcoin. So yeah, the AI is basically agreeing there. The key risks being treasury companies. Institutional buying is really strong. Fear and greed is also a strong factor for Bitcoin. Key point, that's not the Bitcoin fear and greed, which is rubbish. That's the S&P 500 fear and greed. That's the only one that matters. And yeah, a few more things there. So that's good. We've talked about a lot. Water, oil. We haven't looked at the VIX. Let's see. I think we've got it in here. Um, we've got some comments. So, what's the most overused and useless indicator that you see retail follow? The most useless indicator is stock to flow. That was useless from day one and it remains useless because it's overfit, completely overfit. And there's about 50 different versions where he's changed the formula so that it fits his narrative. I did an article on that like, I don't know, 5 years ago where like already 10 versions released in like a year. So it's rubbish. All right, VIX is the volatility S&P 500. The roughly 30 level is usually, and this has worked for a long, long time, but this is like a dip level, if you will, or like a key threshold. Every time we go above 30 is basically some kind of panic in the markets. Um, and it doesn't necessarily mean you just want to buy, because you can spend a long time there, like in 2008. But it's like the dip opportunity. So let's get the S&P 500 here. And this is important as well for Bitcoin today. All right, so you can see pretty quickly in my very rough chart here that every time we go above 30, you get some kind of dip in equities. Sometimes they're tiny and not very valuable. Sometimes they're more valuable and quite significant. Now, with a lot of these metrics, you don't want to just go all in at the first signal of something promising, like a dip over 30, sorry, a spike over 30 for VIX, because you can spend a long time there, like we did in 2008. It's more interesting when you cross back under. So, like right here, right, you might miss some price movement, but you have de-risked significantly, and you can see just from there the price just goes straight up. So that's a really nice one. So when you kind of enter above 30 and then you exit, great buy signal. And you can just very quickly see that applies pretty much everywhere in the last 20 years, 30 years in S&P 500 history. So as long as we're below 30, this is super bullish in my opinion, because there's fear in the market, people are pricing it in, volatility, and it's already played out more or less. And it just plays into the other factors we talked about, like wars being net bullish, oil hasn't yet closed above 100. So all these things could change. Like we could chat tomorrow and this could be over 30, invalidated, very bearish, or not bearish, but at least very uncertain in the near term. So right now, as long as it's below 30, that's a great sign. We want to see this come down though, not go back up. But yeah, I think we've covered pretty much everything. Macro, Bitcoin. I will touch on this. This is a really powerful new feature we just released, the stock screener and crypto screener. So there's over 600 stocks, over 600 cryptos, including Bitcoin here. And this is basically running AI on every single asset and all the data here and ranking them based on their technical setup. And you can see tons of data. So fundamental data, targets and stops for the current setup, volatility, risk reward ratios. So the highest opportunity ones are ranked highest. More info on these pages, of course, if you want to read about it. But again, this is like hours of LLM processing just to produce a summary, and you can obviously get that view real quick. So let's have a look at one. For example, BG is just rated really high from a technical setup. It's seen as a breakout on both weekly and monthly timeframes. There's different type of technical setups this will capture as well. You can quickly see it's got pretty strong 1 year revenue growth, up 75%. You can see the PE is 30, which is not too high. So it could be interesting. Market cap. You can filter, of course, by all these. And you can dive in and get some more detail. So you can look at the chart of each asset, but also the analytics of them. So things like the AI's score, its reasoning, how it got to that score, what industry it's in, tables of financial data, etc. So all of this down here in the doc, quarterly and annual financials. It's key revenue areas, business summary, how the technical breakout works. This is all generated by AI using our proprietary data. And if we just look at the price chart, so I'll just hide the doc for a second. If you've worked with price charts before, I think you'll agree that this is quite interesting. Just applying some basic technicals. Oh, wrong place. There's a monthly breakout. There's also a weekly breakout. Yeah, there it is. So that's super interesting from a technical point of view. And then, of course, you got all the fundamentals here you can explore. And it's giving what's it giving? Target of 180 on the weekly time frame and 160 on monthly. So that's like 30 to 50% return, and a stop just a few dollars below where we're at. Again, these are not perfect. If you're a skilled trader, you'll say, okay, I don't think that's the right stop or target or whatever. Fine, but this is how the AI systematized and done all of this. And I think the results are really good. We've been building this for a while and very useful. I think there's some nuance to managing each individual asset that you can overlay on top of information like this. But it's a really great way, in my opinion, to identify the best assets at the moment, or at least screen the ones that are moving fastest, and help manage your investments that way. So also got the strongest sector. You can filter by type, and you can get ETFs as well if you want to look at that kind of stuff. You can apply the filters here. Same thing for crypto. Obviously, we don't have the balance sheet fundamentals, of course, but we have funding, market cap, and there'll be more to come. This just came out yesterday. Unsurprisingly, there's not a lot of setups here because crypto's been down a lot lately. I like anything above 80 is okay, above 90 is even better for a technical score. And then you can do some nice filtering. Like if you want low funding, you might find Tau or Ban here. The setup's not as good as technical, so it's not as clear cut. But it's still quite interesting if you're into trading crypto. And it's got a similar kind of doc page chart layout, which also has funding rate charted as well. So you can get a view of how shorted or long this asset is. So Tau, for example, has been heavily shorted in the last few weeks, had a squeeze here. And from a technical point of view, that looks pretty damn interesting to me. It's a kind of false breakdown, break back into the range setup. So if you think Bitcoin's going up, that could be good. I'm not giving any kind of personal view or opinion on any of these assets. This is simply what the AI has done and identified. So do your own research and make your own assessments, of course, and manage risk always. Not investment advice here. So got another question here in chat. Do you have a metric that shows the total revenue of the entire mining industry? No. I haven't really found that to be like we could do that, but we could estimate it. I'm not sure it'd be that useful. The thing is that all metrics and markets can get overextended massively. So you can get revenue spike up huge, or go to, you can get MVRV, have massive spikes and come back down. It doesn't mean it's going to do that again. So that's why upper bounds like revenue, for me, not interesting. Where it's interesting is at a floor, where things become a pain threshold, and that's really the cost of production. And the cost of production here adds that, you can read the articles, details about it, but it's approximately a 20% buffer based on industry research from electrical costs for all the operating costs. So revenue, we actually have miner price, which is like the value of Bitcoin to a miner because it also includes transaction fees or block rewards and fees in the block, right? So sometimes when you get high traffic, you actually get more per Bitcoin. So the delta between miner price, gray, and production cost is all profit for the average miner. So some will have costs below this, some will have above this, but the average global miner, the profit is the difference between that gray line and the orange line. Um, so you can think of revenue per Bitcoin on a Bitcoin basis, just the price or the miner price. Yeah. Um, so yeah, that's that. I think we'll finish up there. We also have other strategies by asset if you want to dive into it more, um, and see how that all works. So this is our strategies we also run internally on Capital. Um, and yeah, there's details about it. There's stats here, return metrics, and you can read about it. But otherwise, I'll park it there today. We might dive into those in more detail next time. For now, the Bitcoin rally looks really promising. Like I said, to summarize, I think we're probably going to see 80K soon. And then the opportunity upside from there really will depend over the next months what happens with risk assets, oil, war, and if the core team can sort themselves out and start working on quantum. But thanks, guys. It's been fun. We'll see you next time.